Hi, I'm Steve LaFrance and hope you had a wonderful Thanksgiving. Here's our November market wrap-up. Markets were mixed last month with the S&P posting a modest 0.2% gain, its 7th consecutive monthly advance. Under the surface though, we saw a clear divergence. Large cap growth declined 1.8% as AI-related names came under pressure, while large cap value rose 2.7%. The Dow and the Russell 2000 both outperformed the S&P, reflecting strength outside of mega-cap tech. Healthcare was the standout sector, surging 9.3%. In fact, 8 of the 11 sectors beat the index, while tech, consumer, discretionary, and industrials lagged. This rotation reminds us that leadership can shift quickly, and diversification remains essential. International equities were mixed. Developed markets gained 0.6%, while emerging markets fell 2.4%, yet both remain well ahead of the S&P year to date. The Fed continues to be a key driver of sentiment. After Powell's late October comments that a December cut was, quote, not a foregone conclusion, end quote, market implied odds for a third consecutive cut fell to around 40%. But late November data, including rising unemployment and softer inflation, push expectations back around 80%. With the release of this week's ADP job report, futures markets now give a 90% probability of a Fed rate cut at the December meeting, which can be interpreted as bad news is good news. This tug of war was one of the main drivers for volatility this past month. Meanwhile, the AI trade entered a new phase and was the second primary driver for volatility. Investor enthusiasm has shifted from broad infrastructure spending to questions about real-world application and monetization. Concerns about valuations and debt-funded expansion weighed on mega-cap tech, with names like Nvidia and Amazon down double digits at times. Oracle's nearly 40% decline since September highlights the growing anxiety around costs. While AI remains central to most 2026 outlooks, investors are becoming more selective, looking for tangible evidence of revenue growth and productivity gains. Quick note on retirement benefits for next year. Medicare Part B premiums are set to rise nearly 10%, reaching $202.90 per month in 2026. At the same time, Social Security checks will increase by 2.8%, or about $56 a month for the average retiree. Since Medicare premiums are deducted directly from Social Security, that increase will eat up a significant portion of the COLA, leaving many retirees with something closer to an extra $38 per month. It's a reminder that healthcare costs remain a key factor in retirement planning. As we close out the year, it's a good time to revisit allocations, rebalance concentrated positions, and consider tax strategies such as Roth conversions. Remember, volatility is normal, but discipline turns uncertainty into progress. So we hope you enjoy this season with your family and friends, and thanks again for your continued trust and confidence.